Hello, and welcome to Financial Fluence, where we'll teach you the most up-to-date strategies and tricks for making money online. Don't forget to subscribe to the channel, hit the like button, and turn on the notification bell to be notified every time a new video is uploaded. Also, don't forget to leave a comment down below. In today's video, we'll talk about how you can survive an economic recession. Any economy's backbone is made up of banks. Even the Fed is a bank. But it is unique in that it creates money. What if I told you that any bank has the authority to generate money? You could theoretically open a bank and begin making money. But there is a simpler approach. Why spend so much time and money founding a bank when you can start a cryptocurrency and become a crypto billionaire in no time? At least that's how things have been lately. If you think cryptocurrencies are a con, you probably don't know anything about the banking system. So in this video, we'll look at 5 money truths that banks don't want you to know. Because if everyone knew, the banking system would collapse. Or as Henry Ford put it, it's enough that the people of the country don't comprehend our banking and monetary system. If they did, I believe there would be a revolution by tomorrow morning. Number 1. Credit cards are the bank's nuclear weapons. 70% of people with credit card debt admit they won't be able to pay it off this year. Consider what that implies for a moment. Credit card debt isn't the same as a mortgage. It isn't the same as 3.5% per year. It's most likely around 20%. What makes you think you'll be able to pay off your credit card debt in a few months when it's become considerably larger if you can't pay it off now? In other words, 70% of Americans are on the verge of becoming debt slaves. More than half of those polled, 56% of them, said they've held credit card debt for at least a year. And the majority of them will continue to do so for years to come. Almost 20% believe it will take them more than 3 years to pay off their debt, while 8% say they have no idea when they will be able to do so. And that's how banks make their money. Most individuals spend without considering how they'll pay it back. They've grown accustomed to a certain way of life and are willing to keep it, even if they can't afford it. This is why banks will continue to call you to try and sell you a new credit card. Don't get me wrong, correctly using credit cards is beneficial to your credit score, but if you're not financially responsible, you should avoid falling into debt. Number 2, you can make money by borrowing from banks and investing elsewhere. Mark Zuckerberg financed his $5.95 million Palo Alto home with a 30-year mortgage in July of 2012. At 28, he was the world's 40th richest person with $15.6 billion. Why go into debt if you have billions of dollars? If he wanted, he could buy a dozen $6 million homes in cash. Why get a mortgage? The answer is free money. I know, that's unbelievable. Who gives a billionaire free cash? Why give someone free money unless it's for charity? Interest rates dominate. Remember how we mentioned it's not worth putting your money in banks since they don't beat inflation, resulting in a loss. The situation is reversed here. In the US, inflation is 2.5 to 3%. So any money you borrow below that is free money. Zuckerberg's mortgage rate was 1.05%. The bank loses money since the mortgage rate is below inflation. Math isn't hard. Consider borrowing $1 million at 1.05%. Before the pandemic, the average savings account return was 2.4%. It's now under 1%. Even if you put $1 million in another bank at 2.4%, you'll make $24,000 a year. The bank that gave you the money requires a monthly payment of $10,500 or 1.05%. What could you do with $100 million or $1 billion? When you can borrow money for free, you should use your own money instead. In small amounts, this may not make sense because the difference isn't considerable. In large amounts though, 1%, 2%, or 0.5% can be tens of thousands or even hundreds of thousands of dollars. Number 3, every bank has the right to create money out of thin air. If I said banks produce money, you wouldn't believe me since only the Federal Reserve can. It's the only entity that can print money and issue dollars. The banking system allows any bank in the country and the world to generate money based on the quantity deposited. Consider depositing $1,000. How will the bank spend all that cash? It's useless to hold it. They couldn't pay you your miserable 0.5%. So the bank lends it to someone who wants to buy a car or a house and receives much more interest. Credit card rates average 20%. That's hundreds of times the bank's limit. The bank won't tell you who gets your money. The bank will tell you when you check your account that your money is still there and you can withdraw it. Where did the bank get your money to lend to someone else if it's still in the bank? That's called fractional reserve banking. Banks must lend out 90% of deposits. For every $1,000 you deposit, the bank lends another $900, increasing the total to $1,900. The bank magically found $900, but the computer only has numbers. It's easy. Number 4. Keeping your money in a bank is a scam. Let me ask you a question. If you deposited your savings in a bank, how much interest would you earn? At first glance, it appears like at least a few percent is required for it to make sense, correct? However, when you look at the numbers, it's clear that this isn't the case. The largest institutions, such as the Citibank, provide a paltry 0.5%. Although some banks provide a higher rate, it's still less than 1%, especially because interest rates are currently at an all-time low. Consider that, for a moment, while inflation is 2.5%, your money rises by 0.5%. Every year, the intrinsic value of your wealth plummets. You'd be much better off spending that money right now, rather than putting it in a bank. In a few years, your money will have substantially less purchasing power than it does now. When inflation is high, as it is right now, asset prices such as homes and stocks rise enormously, as we have seen in the previous year or two. A bank is a place where you can keep your money rather than make it. Number 5. The richer you are, the lower the rate you get. Banks aren't charities. They're businesses that aim to maximize profit. Stockholders demand answers. If their business model fails, they won't survive, so they prefer to lend to the rich. If you're a billionaire, the bank can rest easy knowing no one is worried about you defaulting on your loan. If something goes wrong and you can't make your monthly payments, you can sell a section of your business to settle your mortgage, making the money you lend nearly risk-free. Through the years, the banking system progressed to the point where banks exclusively served the nobility, those with money or assets that generated steady revenue, such as land. Compared to the average employee who may fall ill or lose their job, it's risky to lend to the poor. It's simple to point the finger at banks for this, but think about it. Would you feel comfortable lending money to a friend who makes very little money, or to one who owns a business? It's probably the latter, regardless of how harsh it seems. So, if you want a lower mortgage rate, a lower credit card rate, or simply better borrowing terms, you must first improve your financial situation. Banks also give such low mortgage rates in order to build close ties with wealthy individuals, so that they will come to them when they require a larger loan. It's a win-win situation for everyone. Blockchain and cryptocurrency technologies promise to change this and democratize banking, and they will most likely do so to some extent. In reality though, banking has been democratized to the point where everyone can use financial services. Consider what it was like a century ago. And that's all. If you enjoy similar stuff, check out my other videos. And if you like it, hit the like button, subscribe to the channel, and turn on the notification bell. If you have any questions, feel free to leave a comment down below, and I'll see you in the next video.